Hi, I'm Tekoa De Silva, and I'm sitting down here today with Mr. Rick Rule, Chairman of Sprott U.S. Holdings. Rick, good to see you as always.
Pleasure, Tekoa. Thank you.
So what I'd like to ask you about today is an increasing trend that we're seeing in the resource and mining industry today, and that is M&A takeovers. It started, over the last year we had a couple sort of high-quality takeouts, things like Dalradian Resources, Nevsun here recently, and now we're seeing more and more mergers. What are your thoughts on this development?
Well, first of all, it's a good thing. The industry has too much general and administrative expense. There are too many companies in a business that's too small. So almost anything that you can do that thanks and excuses one set of management teams and rationalizes more assets under fewer managers is a good thing. And, pardon me, good for many reasons. Larger companies have more trading liquidity and a lower cost of capital. And in a capital-intensive business, a lower cost of capital makes them more efficient. We've already talked about lower G&A, but a second thing that happens, and this is odd, but you'll understand it to be true, a company that has more assets under administration has more opportunities to allocate capital efficiently. To put it bluntly, they don't have to put a marginal project in production to keep their jobs. And so I think that the M&A cycle that we're in is a healthy one. It's one that we had the good fortune to predict here at Sprott about 18 months ago. We were coming out of a deep, deep, deep depression in extractive industries as opposed to merely a depression, which we're in now. And we were able to point out that the companies had underinvested in exploration and development for a very long time. And the producing companies' pipelines, development pipelines, were greatly constricted. The fact that they had underinvested for 5 years ironically meant that their balance sheets were in fairly good shape. So the companies had the means to do acquisition and they had the need to do acquisition. And what you're seeing right now is the consequence of the conjunction of means and needs. It's a great thing and it's going to continue.
Rick, you mentioned the initiative that has been generated about 18 months ago. Now, where have you and the team led us in terms of the types of companies and what characteristics have you been guiding us toward?
Well, hitherto, it hasn't totally been true, but hitherto, most of the mergers that you've seen have been strategic, rational acquisitions. Acquisitions where a company made a bolt-on acquisition that made its existing assets more economic. We did see a couple of what I would call desperation acquisitions 18 months ago, where companies that had second-tier assets but first-tier market capitalizations used their market capitalization to raise some money to buy assets that were better than the ones that they had. But on balance, most of the acquisitions are strategic. We're starting to see much more generalized merger and acquisition activity right now. The classic example of that would be Barrick, which exited Africa when it spun off Acacia, coming back into Africa by merging with Randgold. Now, what that acquisition does, of course, is make the largest gold company in the world and add a real talented human being, Mark Bristow, assuming that he elects to stay, one of the best capital allocators in the business, to the Barrick brand. I'm not trying to criticize the acquisition. I'm just saying that it's a different acquisition. And of course, we're in the period now where very high quality assets, you mentioned Nevsun, an asset that we actually were responsible for financing the discovery of. You'll recall Reservoir Minerals made the discovery. It was then acquired by Nevsun. Now Nevsun is being acquired by a Sprott client, Zijin. Very, very, very high quality assets will of course be acquired in any sort of market. But I think what we're going to see increasingly is all ranges of companies participate in the M&A business. Today, Great Panther announced that they were acquiring Beetle Resources, which is to say that a small, very small producer acquired a distressed producer in a very, very, very small merger. The irony, I guess, that on the same day you had by merger the largest gold company in the world created at the same time that two minnows married two is indicative, I think, of the state of the merger market in mining today.
Mm-hmm. So, what segment of the resource space is most attractive to you in terms of positioning for to be a recipient of more of the takeover activity?
Well, internally in Sprott, we are busy reviewing, I think it's 30 M&A targets and trying to get it down to our top 5. If my memory serves me correctly, we've got it down to our top 7 as we speak. Now, those are mostly gold mining companies with a couple of copper acquisitions. One reason for that is, of course, that the Sprott brand name is synonymous with gold, and it's a metal that our investors are more interested in than others. But we also think that the gold mining industry is probably the most ripe for consolidation, given that the gold miners' cost of capital is lower than the base metals companies' cost of capital, and also because more financing options in development are available. So if the question goes to what types of companies are most likely to be acquired, and if the question again goes to commodity, then of course the answer would be gold companies. But I hasten to add that any top quality deposit, irrespective of commodity, will be a prime takeover candidate in the next 5 years. Even greatly out of favor commodities like uranium, if you have a deposit that's in the top decile worldwide in terms of return on capital employed and production cost, will be attractive. We saw at the depth of the last bear market, of course, the takeover, which we've already referred to, of Reservoir Minerals. We saw the takeover, which we all participated in, of Mariana Resources by Sandstorm. So a very high quality deposit, almost irrespective of commodity, will be taken out this cycle.
Mm-hmm. So now these are deposits, not producing mines, right?
Producing mines will get taken out too, but the ones that interest me, of course, are the deposits. The producing companies are often followed by 50 or 60 analysts, which means that the competition for information is higher and the premiums are smaller. While those transactions are more frequent and represent less risk to speculators, the ones that really interest me are the ones where we can get tenfold returns, like Reservoir and Mariana.
Mm-hmm. And you mentioned top decile in terms of economics of the deposit. Can you explain what that means?
Yes, top decile means that they are in the best 10% by deposit worldwide. And top decile two ways: return on capital employed, which means the net present value of the deposit at strip prices. We use the commodity strip in terms of estimating future prices ourselves, relative to the upfront capital employed. So as an example, a deposit that had a $4 billion net present value, that had a $1 billion acquisition cost, would be extremely attractive from our point of view. But the other thing that the companies look at after return on capital employed is the internal rate of return, that is the production cost, how the asset will perform in terms of raising or lowering the consolidated company's all-in sustaining costs. And so both of those are in fact important. We emphasize the former over the latter.
Okay. Now, so does this include deposits that may have economic study assumptions that would require a $1,400 or $1,500 or $1,600 gold price in order to deliver a double-digit internal rate of returns?
We don't. That's a whole different classification. We call that optionality. Optionality was something that worked extraordinarily well for us in the 1990s. But unfortunately, it's a game that other people have cottoned on to now. If you look at the range of optionality investors on a global basis, there's people like John Paulson, Ray Dalio, there's a range of people employing $30 or $40 billion in the space. When optionality was our space in the 1990s, I was sort of competing against myself, which I preferred. Buying the large out-of-the-money deposits in the face of a lot more attention paid to the space, and in the face of competitors who bid the prices up to points that already discount a lot of the optionality, is of less interest to me now.
Mm-hmm. Okay, so top decile, high grade, large size equals high, strong economics, yes?
Correct.
Okay.
Correct. And if you're Rick Rule, you can add in the fact that I am willing to accept a little bit of political spice, where many of my competitors aren't.
So how does this continuing trend, if assuming it continues, how does it trickle down and affect the rest of the resource company segments?
Great question. And M&A is important. It adds both hope and cash to the sector. A carefully constructed merger, and we've seen some pretty good ones lately, benefits both the acquirer and the acquired company. The acquired company shareholders benefit first. They get a premium, which excites them. And they also get either more liquid shares or they get cash, which they reinvest in a sector which recently delivered them a positive surprise. That's extremely, extremely beneficial to the market. What's more important over time, I think, is accretive acquisitions. I remember back in the 1990s, we were shareholders of an exploration company called Francisco Gold. And at that period of time, it was one very similar to today. The outlook for the gold industry was to be charitable, not attractive to most investors. Francisco had made 2 economic discoveries, we thought, but nobody cared. Francisco was taken over by a company called Glamis that was well regarded but didn't have a great growth profile. Glamis paid a 30 or 40% premium for Francisco, so we got paid right away. But what was important is that the Francisco acquisition by Glamis answered an important unanswered question about Glamis. That is, how could they grow? So we were paid a 40% premium in a share that doubled because of the acquisition. We call that the double bump. And I think you're seeing circumstances now. An example would be the B2 acquisition of Papillon. Admittedly, it took place a couple of years ago, 3 or 4 years ago now. But the impact of the Fekola acquisition on the balance sheet and the income statement of B2 Gold will be a case study, I think, in accretive acquisitions by mining companies.
All right, well, Rick, do you think there are any comments that we may have missed in terms of the M&A discussion?
I think it's probably something that we should talk about again in 90 to 120 days because the landscape is changing very rapidly. I can't believe, Takoa, either your foresight or your luck in scheduling this interview on a day where the Beetle acquisition by Great Panther and the Randgold acquisition by Barrick took place. So congratulations.
Well, Mr. Rick Rule, Chairman of Sprott U.S. Holdings, thanks for sharing your comments with us.
Thank you.